Historically, an exchange has done a lot of things that were deemed to be unique, and we sort of talked about some of these things, but unique qualities might be the opening and closing process, halts, dissemination of news and news pending and order imbalances, sources of information about supply and demand, the aggregation of buyers and sellers, price discovery, transparency, speed, fair and orderly, reconciliation, arbitration. Those might have been some of the qualities that might have applied to exchanges and deemed them to be unique in the past. Not sure that's the case today. So I wanted to start by asking each of our panelists, and we'll just go down the line, in your mind, what makes an exchange unique? So Al, would you like to begin?
I'd be glad to, Andy. I think it's all about the rules of engagement. Exchanges provide an environment. We have a lot of different exchanges. They provide different environments. They compete on the basis of their environment. And that environment is a set of rules that people coming to that exchange agree to follow. And so those become the rules of engagement. And it's all about who knows what, when do they know it, and what can they do with it when they know something. Bill Wilhelm down at the University of Virginia has written a book called Information Markets, and he talks about there being 3 ways that people learn to cooperate. People find the cooperation necessary to come to a satisfactory trade. One of them is coercion, and that's when governments say you'll do this, that, or the other, and have the power to enforce it. Or when an exchange, by its rules, once you've agreed to be in that context, the rules coerce you to perform in a particular way under pain of being excluded. The other end of the spectrum is just natural cooperation, and that comes about when people are dealing repeatedly with each other, and they discipline each other through social norms or through economic interaction. The middle ground is where most exchanges live, and that is the intermediation of a human agent, a trusted agent, who knows more than any one participant, but who, because he's going to be dealing with those same people again and again and again, develops a reputation, a way of dealing with people that's win-win. So you have the rules of engagement, you have the human interaction that comes about from repeatedly dealing with the same person over and over again. That's very difficult in an anonymous electronic environment because you don't know who you're dealing with over and over again. So the rules of the exchange have to change to compensate for that lack of personal knowledge.
Thank you. Gary, good morning.
Good morning, and thank you everybody for being here, Bob for hosting this wonderful event. As I thought about your question of what makes an exchange unique, I thought about the concept of a brand. What makes us look at a logo of a very popular company and instantaneously recognize what that stands for? It's the brand of the company. And exchanges are in essence a brand. When we ask what is unique about exchanges, we're really asking the question, what is the brand that you immediately recognize as the characteristics that an exchange represents? And so to extend what Al was talking about, what's unique about all exchanges worldwide are 2 very important features. One is that they are non-discriminatory. They treat all of their members the same, and the other is transparency. And that transparency comes to how members are treated, but it's also to how the assets that are trading on that exchange are handled on a daily basis. And it doesn't matter whether it's commodities, it doesn't matter if it's futures, options, or equities. That transparency is the brand that defines what an exchange is.
Thank you. Bill, good morning to you.
Good morning. Thanks, Andy. Thanks to Baruch for the opportunity to be here today, and Professor Schwartz. It's an excellent event, as always. I think when I thought about answering that question, I thought about exchanges really as maybe one of the original social media institutions, right? We talk about the world becoming more social, right? Facebook, a host of other types of institutions. But exchanges really were one of the original institutions of that nature. You know, in modern, I guess, financial market regulation, you think about exchanges and compliance being sometimes hopelessly interwoven. But exchanges were originally voluntary institutions, right? It was a user community getting together under defined yet flexible rules that allowed the participants to be able to move their lives forward, whether commercially and/or professionally. And it also had the added benefit of having a positive impact in moving forward the lives of the people who mattered to participants, whether it be customers or investors. And I think that continues to this day, and that's really what makes exchanges unique among the ways to intermediate financial market transactions.
Thank you. Brett?
Also, thank you, Andy, and thank you, Bob and Baruch, for this opportunity. You know, when I thought about the question, it's amazing how much time you can spend looking at exchanges and asking these questions and all the different cuts, and to really kind of zero down into this was an interesting exercise to rethink it freshly. So I think the basic uniqueness or the basic function of the stock exchange or an exchange is to provide infrastructure, market data, or the price, as Bob would say, and a regulatory environment for the fair and orderly trading of securities. In some cases, and it varies in different locations, it can be for also clearing and settlement services. And today you also see the provision of technologies either to the members or the customers of the exchange, as well as in many cases to competitors. However, it's worth saying that the evolution of exchanges over time, so answering this question today versus 50 years ago or even 20 years ago has changed quite a bit with the changes in both the technology, the trading practices, and regulations. Has enabled significant competition also to exchanges and from other venues, including ECNs and ATSs and things like that. So I would say today the economic value or the uniqueness is largely determined by what they're providing that is over and above or distinct from that which is being provided by other venues which are doing some very similar things.
Thank you. Asani?
Thank you, Andy, and thank you, Bob, for remembering me. Bob, I remember some years ago you had a conference on volatility, and pretty much right after that we had the big crash. And then this year...
I'm certainly glad we're not talking about volatility today.
And then this year the topic is on exchanges, and we have the Dodd-Frank Act, which is proposing moving a lot of these OTC, over-the-counter instruments to exchanges. So again, it's highly appropriate. And I really look forward to what your next year's conference is going to be on. So I've been actually thinking quite a bit about this topic because for the past year or so, I've been working with some colleagues at the New York Fed on some very detailed data on credit derivatives swaps, CDS. And as you know, those are OTC transactions, and they're sort of very different from the way exchanges are traded. And some of the things we've been looking at the data and trying to see what is the nature of the trade and how would it, and if it's sort of this product is taken in exchange, how would it be, how would it fare? Would it benefit from these unique characteristics of an exchange? So in thinking about this topic, it seems to me that one unique service that the exchange provides is simplicity. And what do I mean by that? So one is it provides a product which is highly standardized. So if a share of IBM is similar to virtually identical to a share of any other company, okay, it's the terms of the contract are highly standardized. You don't have to worry whether this share means something different from another share. Moreover, these products are quoted in exactly the same way. So if the price of a share is $100 today and it's $101 tomorrow, you don't have to worry whether somehow the way the prices are being quoted is different. Now in the OTC world, things are actually quite different. in many respects, the contract terms are not standardized. So if you buy a share of CDS from a dealer today, and then you buy a CDS let's say on the same company from a different dealer, there's no guarantee that those two contracts are going to have identical terms. Nor would they necessarily be quoted the same way. Secondly, the other thing which allows for simplicity is the structure of the market structure. And this goes a little bit to what Al and Gary were saying in terms of the rules of engagement, which is that in the exchanges, I don't have to worry with who I'm trading with, who my counterparty is. Because my counterparty is really the exchange. So I can buy a share of Morgan Stanley today. I change my mind. I get out of it tomorrow. I have zero economic exposure. I can go into and out of an economic exposure very rapidly. Okay? I don't have to worry about who my counterparty is. And again, this is very different from a OTC world, where in OTC world, since these are bilateral transactions, you're always dealing with a specific intermediary. So if I buy protection from a particular dealer, and say a 5-year protection on Morgan Stanley, a year from now I want to get out of it, it's not so easy. I have different options, but I basically have to either deal with the same dealer, I can't go to a different dealer, or have to negotiate with a third party so that my position can be assigned to a different party. And there's a third option. I don't want to kind of sort of go into the details. So basically the point of all this is that in exchanges, you can go into and out of trades very quickly. You don't have to worry about the creditworthiness of your counterparty, who you're dealing with. Okay, so it's a very simple trade, and the product is highly standardized, so the product is also very simple. And this is something very unique based on my study of the OTC markets. It's much more complex. There's lots more complexity in just doing a trade, and there's much more complexity in just the definition of what the product is.
So what I think I hear you talking about is the confidence, perhaps, that participants in an exchange enjoy. And following up on that, perhaps, can for-profit exchanges still be unique? Can they still offer this degree of confidence and sort of investor protection and fairness that you all have alluded to? Sure.
Well, I think that the fundamental strategic issue that exchanges face is the fact that by law they deal with broker-dealers. And broker-dealers are often larger than the exchanges economically, and they grew up in a model, a nonprofit exchange model, in which the exchanges were utilities. And the question is, where is the value afforded by the entire process as the investor interacts with the trading process, broker-dealers and exchanges? How is the value of those services divided? And so as exchanges have become public and developed their own growth imperatives, and as they have, the benefit of being public is you have the capital to invest and grow and modernize. The disadvantage is that you need to make more and more money. And that is anathema to the broker-dealer community. They want to make that money. So it's a very tough balance of power, and you're watching it get fought out in real time.
Well, having lived in both worlds, 25 years ago at an exchange that was not for-profit, and then with ISE as a private company that was for-profit, and then as a public company that was for-profit, the way the exchange competes is night and day. There's no comparison between an exchange that is focused on building its business and making money versus an exchange that's running as a utility. And it's not just the capital that's used for new technologies and new products, but it's also the mindset of the people that work at the company, a completely different driver for success. And the type of people that you want to attract into this business are looking for companies where they can grow with the company, be compensated by the company that's using a for-profit model. And this fight, in a sense, this balance between the broker-dealer and the exchange that you refer to is real, yet both win. And that, I think, is very interesting and is maybe missed too often. The broker-dealers make money by selling these products to their customers. The exchanges create the products in many situations. The broker-dealers are able to process more trades on which they earn commissions by using the technology and the systems that are provided by the exchanges. So there's a healthy balance as they go off against each other on trying to see who can win a piece of that pie. Yet at the same time, if you really think about it, the ability for both participants to succeed in this environment has been enhanced by the competition that's been created. And that only happens with a for-profit model on both sides.
Thank you. Bill?
Yeah, I'll echo some of that and maybe take a different tack on a couple other things. And it's something that the Direct Edge has thought about quite a bit. I think we're unique on this panel, at least, in that we actively sought exchange status. We chose to make the transition from operating as an alternative trading system as an exchange. And to go back to my original analogy, I think it all stays rooted in whether or not you continue to focus on your user, right? And I believe that if you do, the transition to for-profit status can be managed quite successfully. I don't think exchanges are different in the sense of interacting with a user community that has significant market power. I would say, again, whether it's all Facebook users combined or every McDonald's customer combined, they have power that collectively is greater than that of the institution trying to serve them. And I also don't think it's about that transition from trying to make money versus acting as a utility. Exchanges that are operating in a for-profit status, especially public ones, do need something. It's not to make more money. It's to grow, right? And it's to grow in a way that people view as sustainable. And the best way for really any business to do that is to continue to focus on the user. And at Direct Edge, that's what we've tried to do in terms of innovative products and a continued commitment to customer service. And I think an exchange, really like any other business, can manage that transition to for-profit status successfully if it just remains focused on making the lives of its user community better.
So to answer your direct question about can a for-profit exchange still convey that confidence to the market, I think the answer is absolutely yes, because exchanges are still highly regulated entities, and a lot of the things that help to inspire that confidence are in part created by the regulatory framework in which they operate. I see the for-profit issue as one that is more of an economic issue where as they moved away from sort of the membership type organizations or the utility structure to the for-profit structure, there were different incentives involved, and some of that was creating shareholder value and what have you, which was a little bit different than the way that they had perhaps traditionally served some of the members. And I think that evolution, you can see sort of historically some interesting connections with some new startup markets and some new venues that came to provide competition to the market to sort of help keep let's say that for-profit incentive in balance. And I think some of the participants that we see sitting here, in fact, in different times and periods, were actually new venues that entered the markets to provide the competition in a world where the markets were going to become more competitive and by necessity, given the fact that they were moving away from the membership structure to the sort of for-profit environment.
So I think going back to what I said earlier about complexity versus simplicity, if you step back and ask the question, why are OTC markets so complex? They're complex because there is a demand from certain users for more customized product. So maybe you're trading a swap or an option, and you want the option to expire on certain dates, not necessarily on specific standardized dates. Okay. So because you have this demand from your users for for customization, over time, as the sophistication of users grow, presumably there's a greater demand for customization. And as Bill and Brett referred to, for-profit exchanges have to respond to the needs of their users. And that is why you have this proliferation of sort of new markets and services which are providing highly specialized services. For example, for someone who wants to trade a very large block of shares with a lower market impact, or someone else who wants to trade very, very quickly. So these kinds of very specialized needs, it's difficult for the exchange to meet it if they keep their product structure and market structure as simple as it was traditionally. So I think that's sort of the tension. So the exchanges are trying to meet this need without kind of losing their brand, I think as someone said, which is essentially simplicity. And so I think it's an interesting question, how that kind of trade-off and that tension is going to kind of play out.
One of the things perhaps we've learned over the years from Bob's conferences is the importance of innovation. And certainly competition stirs innovation. And let me try and frame this question for you all. It's been said by many that bad outcomes often start out as very good ideas. And with a sometimes singular focus on promoting competition in this country, we now are up to, I think, 14, but maybe it's 15 stock exchanges. So bringing it to a stock-specific sort of orientation, I think there's an exchange opening on South Beach, which I'm hoping I get to go to ring the bell. Might be kind of fun. But in that environment, perhaps has this competition sort of at any cost, at all costs, ruthless competition, whatever you might want to call it, has that caused exchanges to lose some of their uniqueness or some of their brand or some of the things that they might bring to their investors? And maybe let's go in reverse order. So, Asani, how about if you take that one?
So I think there's sort of there are two tensions I see, which is one, within the business model of an exchange, there's this tension where they need to reach out to a wide variety of users without sort of doing harm to their brand and their traditional users, which kind of value the simplicity. So I think that's sort of a business decision that each exchange has to make as to how far it wants to go in that direction of trying to kind of meet the needs of more specialized users. Now in the other direction, I think it's also interesting that some of these non-exchanges, some of these over-the-counter markets, they are perhaps becoming more exchange-like. So there's this proposal now in the Dodd-Frank Act to move some of these products to exchange-type systems. So maybe we are kind of going to a world where these different paradigms that we have today, the OTC world and exchange world, are kind of moving together, moving towards each other, and they're becoming sort of less sort of different. And I think from the regulator's view, so the question is to what extent these kind of changes, what does it do to the stability of the financial system as a whole? Okay? Does it lead to so much fragmentation? Does it lead to a reduction in transparency so that regulators don't know where the risk is in the system? And I think that's kind of an evolving issue which is going to kind of play out in the next few years.
Thank you. Brett?
Yeah, I mean, I think the beauty of our economy and our economic system is that competition thrives, and that helps to stimulate innovation and competitive pricing and a lot of good things. And when you ask the question about brand, I think if you go from a world where a market has 80% market share and it ends up where it has 20% market share or less or maybe a little more, does that affect the brand? In some respects, yes, but that's evolution of the markets and it's evolution of competition. And so, so those are good things, right? And we all remember the debates of competition versus fragmentation when Rule 390 was going away and we had to debate the central limit order book back in the day. And the decision came out that, you know what, we actually have to move away from a monopolistic environment and stimulate competition and allow those sorts of things to flourish. And now it is safe to say that we are experiencing some of the outcomes of that, as you mentioned, with all the different stock exchanges and dark pools and fragmentation of liquidity, and that's created some challenges today that we're still trying to think through. So one could argue that smart order routing and the integration of data feeds and all of these sort of technological innovations have helped to recreate aggregated price discovery and recreate, liquidity pools that are efficient in the marketplace. But I think that as the markets evolve, we will continue to be beset with challenges that we're going to have to figure out. And I think in today's world, we really do have to continue, drilling down on what's happening in our markets and, is the level of fragmentation we have the right level to stimulate innovation and competition, or at some point have we maybe taken it a little bit too far?
Directly answering your question, no, I don't think competition really will impact the ability of exchanges to deliver value to their users. The 15 number, especially in stock exchanges, or 14, whatever it is kind of almost artificial in the sense that 4 exchange groups, Direct Edge, BATS, NYC, NASDAQ, have 99% of all exchange traded volume in the United States. There's a couple at the margin, and that's really a function more of market structure regulation, right, where exchanges cannot offer multiple product offerings under a single exchange umbrella, which is why Direct Edge really pioneered that, right, with EdgeX and EdgeA, and our competitors have effectively copied that in a variety of ways. But I think there is a balance that needs to be struck between the value that an individual exchange can provide to its user community compared to the collective value that exchanges provide to the financial market community at large, especially in contexts where you're dealing with products that have broad retail acceptance and usage. And that's the X factor, that's the C factor, the confidence factor. And market structure regulation, by and large, does a fairly good job of forcing interaction between those exchanges to make sure we advance confidence that most times, and we're getting better at this, I think, every year, that when you execute any trade, no matter what exchange you do it on or how you execute it, you may not always get the hyper-optimal outcome in that individual instance, but you're going to get a rational outcome, right? And that's the framework of confidence and the foundation of the market that allows it to move forward and really propels the economy forward. So there is a balance, I think, that needs to be struck there as multiple venues compete on the basis of individual value propositions. But I think all in all, we're doing a fairly good job at striking that balance currently.
Okay, thank you.
The growth in the number of exchanges that you're seeing is directly an outcome of exchanges trying to innovate. As Bill properly pointed out, if an exchange wants to change their matching algorithm, they want to change from a first in, first out model to a pro rata model, and they want to offer that to their customers and have them both offered at the same time, the only way for an exchange in the U.S. to do that is to create another exchange. The SEC does not allow an exchange to have 2 different rule sets for the assets that they trade. So you literally have to create another exchange. And so what you're seeing is a proliferation of exchanges, but by definition, that proliferation is of innovation, because each exchange is trying to adjust their model and test different pricing, different market structure mechanisms to help grow the business. There are really 2 different types of innovation, right? There is new products. You don't need a new exchange to create a new product. But if you want to tweak your model just a little bit, you need another exchange. That's been very good for the customer. In the options industry, we have seen the growth of exchanges. We're now up to 9. And with each new exchange that has come in, it has caused the other industry participants to step up their game, to develop better technology, to create better pricing for the customer, more transparency, more products. So competition, if you are measuring it based on the number of exchanges, is really just an indication that innovation is alive and well, and you're seeing it in the volume numbers in the industry. It continues to grow as a result of that.
Al?
Yeah, I was I was going to make the same point on innovation. I think looking at it from a macroeconomic point of view, though, there's some interesting observations to make, and that is that there's enough capacity in the exchange business and the alternative trading system business to satisfy all the demands for trading many, many times over. So the innovation that you see needs to be both an innovation in the process and an innovation in the selection of the customer base. The fundamental problem that institutional investors face, which is how to move large quantities of stock in and out of the marketplace with the best possible price, has not really been solved. It's very close to being solved, but the reason the innovation is there is because people continue to think there are new rules of engagement that will allow that to be done better and which will attract more customers. We think that the move to predictive analytics is a fundamentally important break in the way services are offered to investors, and the introduction of predictive analytics forces you to choose, are you optimizing your exchange for liquidity providers, or are you optimizing your exchange for liquidity users? So I very much agree that the competition's good, that it represents an effort to innovate, that it reflects the regulatory structure of having to have one set of rules of engagement per exchange, but I also think that it's important to recognize that the game continues to change.
Mr. Price, the founder of T. Rowe Price, used to say change is the investor's only certainty, and I think that probably continues today. So let's see if we can dial this rhetoric up just a touch, perhaps. You know, depending on the day, you might read that high-frequency trading accounts for 75% of the volume and on its stock exchanges, and the average trade execution size is, you know, 143 shares or something. Now, there's certainly not, that's certainly some institutional volume that's broken up into a million little trades to access the market, but it's also perhaps a lot of other kind of trading. And like anything else, exchanges have multiple constituencies to serve, and the challenge is how do you serve everybody and do it in a way that creates fairness and some sense of confidence. So in an environment where high-frequency trading is that big perhaps, and the incentives to route order flow are really dictated by some perverse, perhaps, or economic incentive. How do we find common ground there? How do we find balance, if you will, where so many investors feel their confidence in markets and the pricing process is severely challenged because they don't quite understand what's going on, and yet the volume growth is so required by most exchanges because that's what they're built on, growing volume. So where do we find common ground there? What's right there? What needs to be reasserted, if you will, to promote the uniqueness of what the an exchange has historically offered? Al, you want to start that?
Yeah, I'd like everybody in the room to blink their eye. Did everybody blink? Depending on the twitch speed of your muscles, that took between 50 and 150 milliseconds. A modern trading system can trade up to 5 times in that period. Every trade involves 4 steps: to observe the market conditions, to orient that to a historical database, to decide whether to act or not, and to act. Very difficult for human beings to compete with that. At the same time, I don't think any of us want to say that it's 1848 and this new unfair technology called the telegraph has been introduced, and people who have telegraphs are somehow getting an unfair advantage over people who still have horses. So I think that the right answer is to let the rules of engagement evolve. If an advance has an unintended consequence or presents a set of advantages to the people who possess it, then in a modern free market, you can either acquire those capabilities or you can have an intermediary emerge with a set of rules of engagement that somehow create a more level playing field, that make it more difficult for that technological advantage to take advantage of you. So I don't think that we should over-regulate. I think we should ask for more innovation.
It's funny, when I blinked my eyes, all I could think about was my father banging on the door of the room saying, "When are you going to get off the telephone? You've been on the phone for 4 hours." I've got 4 kids, and I never bang on their doors anymore because they are on the phone, on the internet, listening to music, chatting with their friends, and using up none of my phone bill. They're using the internet. We're living in a completely different world than we grew up in 30 or 40 years ago. Completely different than the world that we knew 10 years ago. When ISC launched, and that was in the year 2000, just 2 years before that, the reason we couldn't come to market was because the baud speed of a modem was too low. Do you remember baud speed of modems? Right? It wasn't that long ago. And I'm not going to tell you how many trades we can do in 150 milliseconds. You'd be shocked. But that's the world that we are in today. It's the marketplace as we know it today. But let me ask you to blink for a moment and think about the experience you have as a trader today. You get instantaneous executions. You know exactly where your portfolio's value is at any moment in time. You have internet sites that give you data on options, futures, and stock instantaneously during the day, 24 hours a day, over the weekend. You have the lowest commissions that have ever been charged to you as a customer, and you have access to products globally. And all of that because of the structures that have been created. And it doesn't mean we should ever stop trying to find that level playing field. But that is a continuous process. It's an evolution. It requires regulators that understand what's going on in the marketplace and are engaged with the exchanges and with the broker-dealers. But it's a never-ending process, and one that we should not try to move back in time, but we need to continue to move forward to embrace the technology that's available to us.
I have no plans to ask anybody to blink, first and foremost.
I think we do automatically,
And
actually.
Andy, I keep hearing institutions, complain about the decrease in the average trade size. That I think there's a plan in place. The indexes keep going down 2% every day, and we're going to get that trade size way up because everything's going to be traded for under $1.
We were hoping
Isn't
it
that
wouldn't.
great?
We were
So
hoping
I-
it wouldn't come that way.
I don't think increased trade size is necessarily reflective of a healthier market. I'm going to maybe attack this from a different angle. HFT level playing field, I think a lot of that is really unfair and cast poorly, especially in times of financial market stress. People have a love-hate relationship with the stock market and financial markets generally. You can read about speculators in New York papers in the 1920s and probably in the London papers in the 1820s and Dutch papers in the 1620s. They're just different jargon. But I do think there are things that exchanges are uniquely in a position to do, where I think we can do better. Right? One is on education, and I think that's a key difference between a role an exchange can play and a role that a trading system can play. And that's something that exchanges did. The options markets today are better than that, than the stock markets. It really focuses more on, product awareness and education. I think just explaining to people how the stock market actually works and why it's better. I mean, to talk about it in this room, everybody here knows how much better off they are, I think they do, than they were 10 or 20 years ago. That message hasn't really been communicated to the average American. Exchanges used to do a lot more on education 10, 15, 20 years ago, And what's happened is that's receded a bit at the time that the alternative forms of what I would loosely call education, right, which run the gamut from zero hedge to things even worse, have proliferated, wildly. And so that's a role that I think exchanges can play. Not be captive to their legacy brands or legacy perceptions about where they really fit in global financial markets, because I think that's in everyone's long-term interest to do. The second, I would just echo Gary's comment, which is one of engagement, right? We are in the middle of this user community, and we have insight into where the world is going and where the needs of financial markets are going, unlike any other participant in our markets. We get, at Direct Edge, I'm honored in a single day to talk with proprietary trading firm Goldman Sachs, Fidelity, Scottrade, TD Ameritrade, just a host, and really have your finger on where all these segments are going, and that gives us insight that we need to share in a productive, collaborative way with regulators and other stakeholders to make sure that framework of confidence stays vibrant going forward. And then third, never lose sight of the fact that we are also enforcement institutions, right? That's another thing that makes an exchange unique. We police for member conduct. And I think focusing on conduct more than capabilities is a much more prudent and frankly rational way to go in that regard. But at Direct Edge, we're taking that responsibility very seriously and investing more time and talent in it than we ever have before. And I think if exchanges fill their role in those three regards, and maybe the indexes go up a little bit, I think some of these things will start to recede, and rightfully so.
Thank you.
Yeah, I mean, I think that if we asked everybody in this audience, not to blink, but if we asked everybody in the audience, what is your definition of high-frequency trading, you would be amazed at the possible different answers that we would get today. And I can tell you that I can't necessarily define it except to say that people who are trying to trade really fast and at a high frequency, which could include our algorithmic customer business, it could include statistical arbitrage, it could include proprietary sorts of business. There's a whole range of different activity in the market. And quite frankly, just about everybody in today's electronic markets is trying to trade really fast because it's a very fast market environment that we're in. And so, so I think, and I think some of the numbers that are being thrown out there, Andy, are pretty suspect because, certainly it's going to be hard to give a number when we can't really exactly define what we're giving a number for. So, instead of focusing on, I don't know, a category of trader that in some respects I believe is at points in time seems to be scapegoated in the market for all of the market ills, we should really ask what are the questions that we're trying to understand about the markets today. And to me, some of those questions include, what are the different sources of things that are causing volatility in the markets? Is it participants? Is it opportunistic strategies? Is it, certain types of products that are traded in the marketplace? I think another important question is, what is the source of, what is the short-term liquidity provision model that we have today? We don't have specialists the same way we did before. That's changed. We don't have the NASDAQ market maker world, that's changed completely with technology and new rules and so on. So answering that question, not only what is it, but what it should be, is extremely important. And another question is, how should we slow down or stop the markets when volatility gets out of control or things move too fast? So some of the regulatory responses with single stock circuit breakers or limit up, limit down, or things like that help to respond to those sorts of issues. So in my view, sort of focusing on fundamental questions and issues is much more important than sort of coming up with an ill-defined category and trying to figure out, what they're doing that's creating all these problems.
Great, thanks.
So I think high-frequency trading is a set of innovations that responded to the apparent need of certain users for very, very rapid trading. So if you're in a competitive marketplace, it's very kind of hard to say, okay, I want this set of innovations, but I don't want that kind of this other type of innovation. So in that sense, high-frequency trading is here, and the question is, how do we understand it? How do we deal with it? And I think the most important question regarding high-frequency trading or any other type of innovation is what are sort of the network effects of these kinds of innovations? I think that's sort of what makes people some people feel kind of uncomfortable, which is how is it affecting the regular types of trading, the non-high frequency trading, however you define it. So, for example, if you look at what some of these guys are doing, some of these activities are pretty hard to understand. So, for example, we have these very rapid cancellations. So you have these computers are sending out these very high frequency orders, and they're canceled within milliseconds. Now, what is really the purpose of that? What's sort of going on here? And I really haven't seen anything or read anything which kind of explains what the purpose of this kind of apparently bizarre strategies are. So I think it's sort of going back to something Bill and Brett were saying. Education, I think, is very important. So first of all, education in terms of just research, in terms of trying to understand what these high-frequency traders are doing. And secondly, when these guys trade, how does it impact the marketplace in general? So the interaction between these pipes and these orders, and when it's coming into the marketplace, what's happening with liquidity, with price impact, with volatility, etc. So I think that's sort of, I think that's the key right now. It's hard to sort of recommend any kind of policy or some kind of enforcement because, frankly, right now I don't think we have a really good understanding of what high-frequency trading is and what is the impact of high-frequency trading on the market. So I think that to me would be like the first step.
Okay, I want to pose one more question, and then we'll take some questions from the audience. We're in pretty good shape time-wise, I think. But you all touched on two things which I think are really interesting. One is this concept of education, and the other is a concept of enforcement. So if some activity, if we don't understand some of the things that are going on in the marketplace today, then clearly exchanges and everyone has an obligation, if you will, to try and help educate on different products and how they're interacting and the good things that come from those and perhaps the things that need to be addressed. But on the enforcement side, with the concept of huge cancellation rates and seemingly not only rebate arbitrage, but also information data speed arbitrage, which leads people to feel that perhaps the game isn't fair because somebody's getting an edge, and it's not because of hard work, but it's because of something else. How do we address that? How do we look at things and say, gee, we've done this, but it's not really very fair. Let's pull back a little bit. Any thoughts there, you all, on what we might be able to do as an industry to recalibrate, if you will, and perhaps to help educate the regulators because they're going to need to understand what's going on in this market as well?
One point I'll add when we ask the question of why are there so many different types of cancellations in the market and is everything going as fast as it is, there was an interesting speech given recently by Greg Berman at the SEC where he talked about arbitrage in the market, and in particular he looked at the fact that we all know that ETFs are a very significant percentage of the market today, and the participation in the spiders and the Qs and other products like that is huge. So when you think about the pricing of an underlying ETF, so when you or your aunt or your uncle or your brother are buying an ETF, the question is that price the right price, right? And so the way that the pricing happens in an exchange-traded fund is often based upon an arbitrage that exists with the underlying basket of securities as well as with the futures products. And so the participants who are playing in that arbitrage practice are effectively doing many of the behaviors, and this is all essentially what Greg Berman was just talking about, and his speech is online. But many of the behaviors that would look like high-frequency trading. So if you want to be able to keep those in line, you're trading an underlying basket of stocks, you're looking at the futures, you're looking at the ETF, and there's an arbitrage process that takes place, and that's actually what creates efficient price discovery for that underlying ETF. So when you go out and buy it, that's the right price. And look, I'm not saying that all of the different activities that are doing, canceling, trading one time for every million orders or whatever the number is that they put into the marketplace are all good and are all right. But I think on that particular question of cancellations, it's important that we start by saying that in and of itself, that practice or that behavior is not necessarily wrong in today's marketplace. You want to jump on that one? No, go ahead.
No, I mean, I always struggle with this notion of fairness, and I think I segment those into the fair and unfair concerns. Right? I think the unfair concerns are maybe the people who are sitting outside of one of our exchanges today, right? And they think a lot of things aren't fair. I don't think they're worried about whether or not someone's trading it. They have much broader fairness concerns, and they may or may not be valid, but they're really not talking about high-frequency trading. Right? I think with respect to the more appropriate focus, it has to start with an understanding, right? And it's driven by conduct rather than capabilities. And I think education plays a role. I don't think the average retail investor is looking to arb the futures versus the underlying and like, well, so-and-so has a higher speed line or they're co-located, so they beat me to the punch, right? Usually, those people are interacting on other sides of the trade where you're buying SPY to hold it for a relatively long period of time, and you're interacting with a short-term trader, and that interaction is not one where there's a winner and a loser. You're both beneficiaries, and you're both and once again, that's what exchanges are meant to do and what makes them unique, bringing buyers and sellers together in a way that benefits both parties and helps them move their lives forward. The fact that they have different objectives and different capabilities is not fundamentally unfair, and I don't understand anyone who implies that it is. That being said, it is true that the transformation of how trades take place on exchanges mean that we have a similar responsibility to advance our capabilities to understand what is happening on exchanges.
I agree with that.
And so you see a host of initiatives that may be perhaps a bit overdue, but that are advancing, whether they be the consolidated audit trail or large trader reporting. I'm not commenting on or wholeheartedly endorsing the fine details of each of those initiatives, but I think the spirit of them and the focus on them is an appropriate one so that we match our technological and product innovation with regulatory innovation that keeps relative pace. If you do that, I think you can start to prosecute people who are using new technologies to effectuate what are probably some of the oldest schemes in the book, and those fairness concerns, or at least the rational ones, start to fall away.
All right, how about some questions from this crowd? This fellow here. And don't forget to state your name and affiliation.
George Selinsky, Baruch MBA student. Will there ever be a need for a 24-hour equities market like we have the Globex now in the currency market? And will we ever see possibly even markets open on weekends?
No, no, and no. Just a selfish response, sorry. Anyone?
If users want it, yes. If they don't, no, right? And that's the user versus non-user driven innovation. Well, we have a system. We can keep it open all day. Why don't we just do it? People will come. Well, if the user community, if there's not latent demand, it won't occur. Now, exchanges can play a role in fostering demand, especially in that they have on the products. They have on the product side, but it's certainly an idea that hasn't found its time yet in the equities or the options world.
Brett?
Yeah, I used to travel around the country talking to clients, and I remember when the New York Stock Exchange was talking about reducing the hours in the morning to much earlier. Every time I'd go out to San Francisco and meet with clients out there in LA, they would pretty much look at me. Of course, those meetings usually were already at 5 o'clock in the morning because they've got to be 3 hours ahead of time, and they would look at me cross-eyed and say, please don't let them ever do that, because that's just not going to work here. But fundamentally, and to use sort of a cliche, is that for liquidity needs to come together when liquidity is there. So in the U.S. equity markets, if you don't have liquidity aggregating and gathering, then you don't have efficient price discovery, right, Bob? So one of the reasons why you have so much trading around the opens and closes is because liquidity is aggregating during that point, those points in time in particular. I argue that when I talk about the issue of fragmentation, I think of it, that there's fragmentation in terms of place, there's fragmentation in terms of price, and there's fragmentation in terms of time, right? So price, when we went to decimals, we kind of fragmented the price. When we had, I don't know how many exchanges, we fragmented place, but in time, when we went from, an average turnaround time in the marketplace in the New York Stock Exchange, I think it was only, 6 years ago that it was 12 seconds or something like that, an average turnaround time. When we went to seconds, sub-seconds, milliseconds, and microseconds, we actually fragmented time. So liquidity meeting at a point in time is actually more challenging, which helps to explain why we have such low price, why we have such low trade sizes, right? So I actually believe that we've significantly expanded the trading day because we've significantly expanded the increments of time in which we can trade, and that if, in fact, we were to go much farther in terms of the open, there's obviously pre-opening trading and post-trading, right? But there's not a lot of liquidity there. It's very hard to trust those markets except in unique news events. And, I think that I don't, like as Bill said, I'm not necessarily seeing a significant demand for that in any one particular market.
But just to be a little provocative, I think you have to answer the question based on the time frame. How many years are you talking about? If it's in the next 3, the answer is no. And maybe if it's in the next 10, the answer is no. But one reason why you're not seeing stocks trade 24 hours is the infrastructure is not designed yet for that. The clearing infrastructure, currency infrastructure, and the market infrastructures globally so that it looks like one marketplace. Today, it is still really individual marketplaces and very dependent on their geography and place in time. But
Yes,
if we
sir.
think far enough out, I think the answer to your question will be yes.
I'm Joe Rosen, RKA Inc., and I know I'll be accused of being a Luddite for this observation, but so be it. But I'm not a Luddite. I think most people know that. Going back, Alfred, to your analogy about competition telegraph versus the horse and buggy and so on, I think we should make sure never to lose sight that just because something can be done, because the technology advances a certain way so you can do something, doesn't mean necessarily that it's a good thing to do. And just a simple analogy, I mean, I don't know how many have Maseratis here, but if you could do 200 miles an hour with the Maserati, it doesn't mean it's a good thing to be doing that on any of these streets or on any of the highways. So I'll be the last to say that you want to overregulate, and I know that all of you would agree. I mean, that balance is important, but it's important to keep in sight just because you can do something and you can trade in nanoseconds, whatever, pico, whatever it is, doesn't necessarily mean that it's always a good thing.
All right, thank you. That was a statement, I think, not so much a question.
Yeah,
But
sorry.
Yes, sir. I'm hoping this is a question.
May not be a question,
Well, then you might want to sit down.
but I would like to raise this because Brett mentioned about ETFs, and they happen to be, the single most active securities that trade, on exchanges today. And the question I have, because you mentioned about the price, and the arbitrage of the underlying securities. That said, the ETF is a tradable instrument, but it's tradable based upon the actual tracking of the index itself, be it the spiders or the Dow Jones. That said, I just read an interesting paper that Themis Trading did on the phantom indexes. And if anybody has read that paper, which I think is an interesting paper, which basically says that the index itself and where they get their prices from, because everybody looks at that index, and the question is, if you guys are aware where the prices are from, because people do rely on those indexes, and that paper does spell out exactly where they get their prices from.
Well, so I'm not really sure. I understand the paper, right, which says, and this is something that Direct Edge has a small amount of interest in the sense that indices really look at listing market transactions only and not transactions on other exchanges. I think, in all honesty, generally there's a pretty strong correlation, especially with the market structure we have, that listing exchanges cannot trade at prices significantly deviant from non-listing exchanges. So,
Any price disparity gets caught pretty quick, don't you think?
but by law, it kind of has to,
Yeah.
right?
Good. Well, okay, well, hold that for a minute. Okay. Other questions? Yes, sir.
My name is Bob O'Brien, and I have my own company, KCI Technologies. My question is, since you've hinted that a lot of the trading is virtual trading, how do you separate regulation of the virtual trading from the real trading so that you can monitor the market?
What do you mean by virtual trading? I'm not sure I'm with you on that.
Well, you said a lot of the trades get busted.
Oh,
because they're
quotes get canceled, you mean?
Yeah, I call that virtual trade. That's
Okay,
not real
gotcha.
trading.
Okay.
So separate out the real trading, and how do you go after that from a regulatory? I'd like to ask the Federal Reserve guy that.
Asani, that's a question for you. How do you separate the real trading from the virtual trading? Virtual meaning the stuff that's canceled very
The stuff
quickly
which is
before it
canceled.
can be
No, as I mentioned,
traded
I
on.
think it's hard to say what to do about them if you don't understand why these things are being done. So I think sort of, I mean, what is really the purpose behind the people who are doing this? So I think for me, we first have to understand the logic behind this and the impact this is having on the market, and then we can sort of talk about how to, whether it's necessary to regulate these things or not.
Andy, so a thought on that, right? So obviously there's a lot of concern with the amount of message traffic that's in the market, and there's some, as I mentioned before, I was providing an example of where I thought that there was an efficient price discovery function that was provided by that particular behavior. That doesn't mean that, by necessity, it's all, creating efficiencies to the market. So, for example, we have rules against spoofing the market, right? So if somebody were to be putting quotes into the market, or, and we've seen regulatory actions as well related to layering, right? So if somebody's putting quotes in the market and they're layering, or they're spoofing the market, or they're doing strategies that are in violation of existing regulations on the book, then by all means, let's hope that the regulators are looking at this and properly enforcing against those sorts of activities in the market, right? So I think, the key is that there are some cases where there might be, legitimate or explainable strategies where, it could be pricing based upon paired securities where multiple securities are moving, and so that's how that trading strategy is providing an efficiency in the market, and then others which may be, manipulative or violating of some rule, in which case I think it's important that the existing regulations are utilized to properly enforce the inappropriate behaviors.
It's also worth pointing out that the parameter life of an order is one of those rules of engagement that could be, through innovation, offered in a different way. And then you'd have to see whether people wanted to go to a market that had a required life of an order.
Good. Well, thank you all very much. As you can see, I think from this wonderful discussion, we all have a lot of work to do. We need to demystify some of the things going on. We've got to encourage enforcement. We've got to encourage education, and we've got to encourage and reaffirm that sense of fairness that all of our markets and all of our businesses, frankly, depend on. Please join me in thanking our wonderful panel, and you're welcome to continue this conversation at the break.
I have to take notes just to keep my thoughts organized, otherwise
I've been trying to do that too.
Yeah.